Hi. Today I'm gonna prepare adjusting entries. But what is adjusting entries means? So, adjusting entries is are required every time a company prepares financial statement. The company analyzes each account in the trial balance to determine whether it's complete enough in the debt for financial statement purposes. Every adjusting entry will include one income statement account and one statement of financial position account. I'm going to simplify these statements. Adjusting entries basically are journal entries made at the end of period to record accrued expense and revenue and deferred expense and revenue. That's it. So let's prepare the adjusting entries.
So, hi guys, this is my Word and this is my balance sheets in Google Spreadsheet. So, I'm gonna rewrite these accounts from Word to balance sheets in Google Spreadsheets. So, let's go. Okay, let's jump straight to other data. Number 1, prepare insurance is a year policy starting May 1, 2014. This is prepared expenses. Prepared expenses are the costs that have been paid but are not yet used up or have not yet used expired. As the amount expire, like this, because the period is ended. So we have to deduct our current asset. Before we deduct our current asset, we have to multiply 1 over 12. Because we use the insurance 1 month. And then the amount of the reduction is reported as an expense. Number 2, account of supplies shows $350 of unused supplies on May 31. This is prepared expense. There is a $50 of supplies are left in our current asset. We only have $350. And then the amount of the used supplies is reported as an expense. Number 3, annual depreciation is $2,640 on the buildings and $1,500 on equipment. Annual depreciation is $2,640 is for a year. The equipment and the building are depreciated 1 month. So we divided 12 from annual depreciation and adding both depreciation, adding both accumulated depreciation as a depreciation expense. Okay, next, number 4, the mortgage interest rate is 12%. The mortgage was taken out on May 1. Okay, the bank or financial institution has been charged the company 12% of interest rate. So we multiply 12% and multiply 1/12. Because again, the period is ended. And then reported as an expense. Next, 2/3 of the unearned revenue has been recognized for services performed. This is deferred revenue. It's what we get uncollected money, but service related to what that revenue pays for over a period of time. On the last May, we performed 2/3 of unearned revenue, so we deduct our liability liability that we performed and reported what we performed on a revenue, on a rent revenue. Okay, next, number 6, salaries of $750 are accrued and unpaid May 31. This is accrued expense. We haven't paid to our employees yet, so we accrue as a liabilities and under the accrual method we have to report salaries expense account. So, wow, the balance sheet still isn't balanced. How can that be? So, 6,675 as our profit. Now we have to flow through the retained earnings and balance our sheet. Okay.